Hello, and thank you for watching. My name is Bradford Roberts, Principal Broker, Founder, and Owner of TR Realty in the Las Vegas area. After watching this video, please be sure to like it as well as subscribe to our YouTube channel. Download the pertinent handouts for this video by clicking the link in the comments below. Now let's get started. This video is entitled Class 2 Real Estate Behind the Scenes. This segment is entitled Finance. I highly recommend our in-house lender, Michael Ivanov with We Lending. These guys really do a fantastic job for the associates here at TR Realty, and I'm very proud to work with them. What I'm going to be doing now is starting with a list of services that are provided to us by the lender, and then we'll be getting into a lot more detail about the concept of finance. Starting with the very first thing on my list today is that our lender can either pre-qualify or pre-approve your buyers. Now, a lot of people use those words interchangeably, pre-qualify and pre-approve, but they are very, very different. A pre-qualification is just a process of talking to a prospective buyer and asking them some basic questions. How much is your income? What are your assets? How much are your housing costs, and those sorts of things. But those things are not verified for the pre-qualification process. That's why at TR Realty, I highly recommend we don't work with pre-qualification letters at all. The pre-approval process is actually verifying all of the information. So this is where we ask the prospective buyer to provide us with tax returns, bank statements, pay stubs, and the like. So pre-approval, very different than pre-qualification, much stronger. If you're working with buyers, you should only work with pre-approved buyers. And if you're on the listing side, frankly, and an offer comes into you, you only want to work with an offer that is received by a pre-approved buyer. That's my opinion. So the lender can pre-qualify or pre-approve, and we definitely want the pre-approved. Next on my list is the credit check. So the lender will check the credit report or reports. Sometimes they check one, sometimes they check up to 3 different credit reports. And we can't talk about checking someone's credit without having a little discussion about FICO scores. FICO stands for Fair Isaac Company. And Fair Isaac was the first company who really created this mathematical algorithm that was designed to put a quantity, a numeric value, on someone's credit worthiness. Now, over the years, credit scores have become more complicated, but basically FICO scores range from a low of 300 to a high of 850. If your credit score is close to 300, which is very difficult, by the way, you are pretty much a deadbeat. If you've got a credit score down close to 300, you've probably never paid a bill on time, if ever, in your life. And conversely, if your credit score is 850 or close to it, you are basically perfect in every way. You've never paid a bill late, ever, ever, ever. You've managed your credit wisely, etc. Most people are between the mid-500s and the mid-700s. I also want to mention that FICO scores can vary with the 3 major bureaus. So there's Experian, there's Equifax, and there's TransUnion. Chances are, if you were to pull your credit report and look at your FICOs, you would have 3 different FICO scores for those 3 different credit reporting bureaus. So this is something that the lender will work with you and educate you about how these things work. Third on my list is to assist with credit improvement. Now, this is different than credit repair. Credit repair can have a bad name. I mean, when I hear credit repair, I think of companies that charge upfront fees, basically like scams. That's not at all what I'm talking about. I'm talking about credit improvement. So what I mean by that is often when we check our FICO score, it is in a certain group, or what credit reporting agencies call tiers. So lenders typically work, let's say, between 620 and 660, between 661 and 700. I'm just making up those numbers for point of illustration. But they work in those groups or those tiers of numbers. Sometimes when we check our FICO, our score can be just below pushing us into another tier. And of course, the tier determines not only the interest rate that we pay, but other terms and conditions on our financing as well. So we want to be in a higher tier, okay? So example, if you're working with a particular lender that has a tier that starts at 720 and your FICO score is a 717, obviously very, very close to being in that next tier, meaning you can get better terms, conditions, and interest rate on your mortgage. If there's something we can do to take that 717 and turn it into a 720, then that would be beneficial, right? So a good lender like Michael Ivanov is actually going to work with the borrower, or what we call in real estate the buyer, to see if there's some way we can improve that credit and get that person into the next tier. Sometimes it's as simple as closing an account. Sometimes it's as simple as perhaps reducing available credit on a credit card. Sometimes it could be as simple as paying off an old account or paying down a balance. There's all kinds of things that can affect someone's credit score. Michael is an expert and will guide you accordingly on that. The next thing on my list is the lender will assist with trade lines. And when we say trade line, we're talking about the history of an account. So example, if you've been with a cell phone company for a long time, that is a good trade line. If you've been paying a mortgage on another property, that is hopefully a good trade line for you as well. And there could be things like credit cards that come to mind, perhaps medical payments, other things where you go out and you establish credit. Could be a furniture store, an electronics store, a retailer, what have you. Each of those is considered a trade line. And most lenders want to see a bare minimum of 3 trade lines that are being paid responsibly. Now, if you've got a credit card that you pay in full every month, that's a good thing. It's helping your credit score, but some lenders might not consider that to be a trade line because you're not really making installment payments. A car loan is a perfect example of a trade line. If you are paying that car loan on time every month, that would be an excellent trade line for you. So keeping in mind that most lenders want to see a bare minimum of 3. And if you can get into the 4, 5, 6 trade lines that you've had for a while and you've been paying on time, then that is really excellent. Another thing that a good lender or a good mortgage broker can help you with is advice on what's called sourcing and seasoning. Sourcing and seasoning. Let's take a look at what those 2 words mean. So when it comes to sourcing, lenders want to know where your funds have come from, right? They want to make sure that last night you didn't borrow $25,000 from your parents and all of a sudden they wired that into your bank account. That's not very good sourcing. The best kind of sourcing we can have when it comes to applying for a mortgage would be money that you've accumulated over time from your pay, from your paycheck, from your salary. If you're able to, let's say, save $50 every time you get a $500 paycheck, and you're doing that over and over and over again, and you're accumulating those funds for a down payment, that is absolutely a sign of responsibility. So sourcing has to do with where the money is coming from. And the sister concept that I mentioned, which is called seasoning, has to do with how long the money has been sitting. So lenders would consider it to be very concerning if your bank account balance has been around $100, $200, and then all of a sudden you've got $40,000 in your bank account. That money just arrived somehow, right? Just fell down from a tree somewhere. So that's not very good seasoning. When we talk about seasoning, we're talking about the length of time that the money is actually sitting in your bank account. And there are some loan programs, specifically some types of FHA programs, that have very specific seasoning requirements. And a good mortgage broker like Michael Ivanov will be able to tell you if you're trying to get that kind of loan program, they'll be able to tell you how long that money needs to be seasoned before you could actually qualify for that program. So sourcing and seasoning, two components of getting a mortgage that really need to be thought of in advance before this process begins. The next thing on my list is assistance with the actual mortgage application. So when we talk about an application, you can probably assume that it's going to ask for your name and your address and your social security number and your driver's license and where you work and those kinds of questions. Yes, a mortgage application will ask all of those, but a mortgage application can be more lengthy, more detailed, and can encompass a lot more information than just those basics. Therefore, it behooves you to work with the mortgage broker, work with the lender in filling out that application so it is the best it can be, so it slants toward your advantage. And by the way, we talk about the word mortgage. Maybe this is a good time for me to interrupt myself and clarify exactly what I'm talking about. So actually, here in the state of Nevada, we don't technically have mortgages. We use an instrument referred to as a deed of trust. Generally speaking, for states east of the Mississippi, they have mortgages. Here, typically west of the Mississippi, we have deeds of trust. Now, for our purposes in real estate, they pretty much work the same way. And the word mortgage has been used all over the place. It's ubiquitous in our speech. Everyone's comfortable with the word mortgage, so we kind of say mortgage, even though technically here in Nevada we do have a deed of trust. The primary difference for us as real estate professionals is that deeds of trust are in non-judicial foreclosure states. Mortgages are in judicial foreclosure states. If you're not familiar with the differences between judicial and non-judicial foreclosure states, make sure you watch my video series for Class 6, which is my short sale class. We're going to get into great detail. But for the purposes of today's discussion, a judicial foreclosure is a foreclosure process that needs to go in front of a judge. A non-judicial foreclosure process doesn't need to go in front of a judge. Therefore, it costs less, it goes faster, and that is typical in an investor-friendly state like Nevada. So there's the difference for our purposes between mortgage and deed of trust. The next thing on my list that I want to talk about here is known as desktop underwriting. In the industry, we call it the DU process, desktop underwriting. So desktop underwriting is an automated system where a mortgage broker enters your information and gets a preliminary answer about whether you qualify for a particular mortgage loan before the actual lender sees it. So this is done by the mortgage broker, because remember, the mortgage broker works for the buyer, not for the lender. So when the desktop underwriting process is done in advance, if we feed that information into the system and there are some issues, perhaps some red flags pop up, the mortgage broker can try to work with that consumer to get those bumps worked out before the application is actually sent in to the lender. And the desktop underwriting process is based on credit, income, assets, and the specific property that you wish to buy. It is designed to eliminate human bias. The next thing on my list is assistance with any requested documents and the preparation of those documents. So sometimes lenders will ask for things like a VOF, which stands for verification of funds. Sometimes lenders will ask for a VOE, which stands for verification of employment. Sometimes they will ask for a VOR, which stands for verification of rent. And there could be other miscellaneous documents as well. rather than a consumer who might not have been through this process ever before, trying to put pen to paper and create something. A good mortgage broker like Michael Ivanoff will actually assist in that process so that those documents are prepared in a manner that the lender is likely to accept. And another thing on my list here is to negotiate with the underwriter. So the underwriter works for the lender. Remember, the mortgage broker works for the consumer. So there is a negotiation process that many people might not even be aware of. Sometimes the underwriter will come back to the mortgage broker and say, this is going to be the interest rate, or these are going to be the terms. The mortgage broker, him or herself, needs to be negotiating with that underwriter to get the best, most favorable terms for that consumer that are possible. Now, I want to mention also that Michael Ivanoff has a program in his portfolio for those individuals who might not have a Social Security number at this time. It's called an ITIN program, ITIN, and ITIN stands for International Taxpayer Identification Number. So in some cases, an ITIN number can be used in lieu of a Social Security number. So if you're working with foreign nationals and they don't yet have a Social Security number, please reach out to Michael Ivanoff and see what he can do to help you in that regard. Toward the beginning of this video, we talked about the difference between pre-qualification letters and pre-approval letters. We talked about some of the differences. I just want to remind you that pre-qualification is opinion while pre-approval is actually fact. And I want to remind you that these letters have an expiration date. Typically, pre-approval letters last for 30 days. And sometimes you're working with a prospective buyer. The process can take a heck of a lot more than 30 days to go out and find a home, negotiate a contract, etc. So sometimes when you're working with buyers, you have to ask for an updated pre-approval letter. We want to keep it current. And of course, this is very relevant. This topic is very relevant if you are working with a buyer of a short sale. You may have to update that pre-approval letter more than one time. Also, I want to mention that getting approved from multiple lenders within a 30-day period of time should not negatively affect the buyer's FICO scores. Just think about that for a second. What if we didn't have federal laws in place to protect the consumer? What could happen is a consumer could go to a bank or a mortgage broker and they could apply for a mortgage and they could be quoted a particular interest rate. What if that interest rate is not very favorable? What if the other terms and conditions of the mortgage are not very favorable? Well, now they're into the transaction time, they've got a closing date set, and it's going to be very, very difficult for them to start over with another lender to try to get a better rate. And during the process as well, before they even put a home under contract, consumers deserve the right to shop around. So there are federal laws in place that say like-kind credit inquiries, such as someone trying to apply for a mortgage, within a 30-day period of time, do not adversely affect the credit score. So if you're ever in MLS and it says, the seller wants you to get pre-approved with ABC lender or whatever, don't worry about that adversely affecting that buyer's credit score. They don't have to use that company. Of course, no one could be compelled to use a particular company. The buyer is free to shop around. But I do hear a lot of questions about the credit score being adversely affected by that second hit. And just keep in mind that there are consumer protections to make sure that doesn't happen. Little strategy I want to share with my viewers today is to have the pre-approval letter come very, very close to the offering price. So what I mean here is, let's say we're working with a buyer who goes to a lender, and the lender issues a letter and says, this consumer can buy a house for $450,000, okay? And let's say we take that buyer out and we find a property that the buyer likes and wants to offer $350,000. If you were to submit a pre-approval letter for $450,000 along with an offer for $350,000, you can probably imagine that we have reduced the leverage. We've reduced the ability of the buyer to negotiate, because the seller is going to see that pre-approval letter and the seller is going to think, hey, this guy can go all the way up to $450,000. Why should I negotiate price with this person? So that's why when I sold real estate, if I had that scenario where a buyer had a $450,000 pre-approval letter, I would talk to the lender about getting a letter for $440,000, $430,000, $420,000, etc. I would get those lesser amounts so that when I was going to submit an offer, I would be able to submit along with the offer a pre-approval letter in the amount that is very, very close to that offering price. And I think that improved the buyer's ability to negotiate. So I hope you understand and that makes sense. During the process of buying a home, we need to make sure our buyer does not change jobs, does not apply for any new credit, does not get any increases in their current credit limits, or does not make any large purchases whatsoever. From the time that we first get pre-approved until the time we close on our home, we want to make as few changes to our credit standing as possible. There's some specific things that I would like to get into, starting with a rate lock. So most of us probably know what a rate lock is. There's a couple of things that I would like to embellish on that topic. So a rate lock is when the lender has committed to that eventual interest rate. Now, I think rate locks are really important because it is a layer of protection, predictability for the buyer. The buyer knows exactly what interest rate they'll be paying, and therefore, with a quick amortization calculator, they'll be able to figure out what their payments are going to be. If we don't do a rate lock, what can happen is between the time we get pre-approved and the eventual time that we close on the property, the interest rate can change. And when the interest rate changes, the payment changes. And when the payment changes, it becomes a question of affordability for that consumer. So especially in a time when interest rates are starting to rise or on the rise, it becomes really, really important to get that rate lock. Rate locks can last as little as 15 days, as long as 90 days, and they're typically done at the time of contract. Most rate locks are free. Some lenders may charge for a longer term rate lock. In a lot of cases, those fees that the consumer may pay could be refundable upon successfully closing that loan. And very closely tied to the concept of a rate lock, I want to talk about something known as a float down. A float down is not a widely known concept in real estate. I know that when I teach my classes live, I ask the room, has anyone heard of a float down? Typically nobody, or maybe one or two people have heard of a float down. So I want to share this with my viewers today. A float down is when a borrower gets one chance to adjust that rate lock. So let's say, as an example, we lock our loan at 4%. And we go out and shop for property, and we're watching the rate drop to 3 7/8, drop to 3 3/4. Well, we've been locked at 4%. So now the rate has actually gone down, and we are kind of being financially penalized for having a 4% rate lock. In the case of a float down, you would actually be allowed one shot between the time of approval and the time of closing to reduce the rate at which you are locked. So it's kind of stomach churning. I know it's kind of a gamble. You could look at it that way, but it can help you as well. If you lock at a certain rate, if the rates drop, You contact that mortgage broker and you say you want to exercise your float down, and that would relock you at that new lower rate. So rate locks with float downs typically last 60 days, but some lenders may even charge a small fee for that. But in my experience, the rate lock with the float down is absolutely worth it. The next thing on my list to talk about is debt to income ratio. So literally debt divided by income. The amount of monthly debt divided by the amount of the gross monthly income. So this is something that lenders are concerned about. Think about it. If you earn $10,000 a month and you're spending $9,000 a month on housing, how can you afford your other bills? How can you pay health insurance and automobile expenses and credit cards and food and other expenses that you have in your life? So we want to keep that debt to income ratio probably down around the 30 percentile, somewhere around there. Now this can vary program by program, lender by lender, but if you've got a debt to income ratio that's somewhere in the low to mid 30s or below, you're probably safe for most loan programs. That's what we mean by debt to income ratio. Now another thing that I want to cover today is something that a lot of people don't know, the difference between the interest rate and the APR. And APR stands for annual percentage rate. If you go to your local bank branch and you're standing in line to make a deposit or whatever people do at the bank, you're probably going to see some advertising in the lobby. Maybe the bank is promoting car loans or HELOCs or mortgages or who knows what they're offering. And they are required by federal law to not just disclose the interest rate, but to disclose the APR. And, frankly, a lot of people don't look at the APR. They don't know what the APR means. So I want to make sure that my team can understand this. The interest rate is the actual cost of borrowing the principal loan amount. But the APR is a broader measure of what it's going to cost you to pay for that loan. Because the APR doesn't just take into account the interest rate, it also takes into account all of the other fees that would be associated with getting that kind of loan. Broker fees, discount points, some closing costs as well. Typically, if you see an interest rate of, let's say, 4%, you're going to see an APR that is greater than 4%. Now, if you saw an interest rate and an APR that were exactly the same, what that should tell you is there's absolutely no fees at all associated with getting that loan product or that mortgage. And we couldn't see an APR that's less than the interest rate. In my opinion, the APR is really what we should pay attention to, especially if there's a great disparity between the interest rate and the APR. It should be telling you that you're going to end up paying a lot of fees. So next time you see the APR somewhere, you're going to know exactly what it is. In the mortgage industry, you will hear people talking about the front end and the back end. And I want to make sure that we understand what that means as well. When we talk about the front end of a mortgage, we're talking about origination fees. Fees that may be charged to the borrower to initiate that loan in the first place. When we talk about back-end fees, we are predominantly talking about something that no longer exists. We're talking about something known as a yield spread premium. Let's go back in time a little bit, because for us to understand the future, we have to understand history as well. Years ago, if you were to talk to a mortgage broker about getting a loan, not only would you be quoted an interest rate, but you would typically be quoted something known as a YSP. And if we go back in time, if you look at a settlement statement from many years ago, if you go to the second page of that HUD-1 settlement statement, the 800 section specifically, for those of you who want to go check it out, you might see something about this big called YSP. And actually, federal law didn't even require the words to be spelled out. So lenders could simply put the initials YSP, and then that would be followed by something that looked very innocuous. As an example, YSP equals 0.25. Now, when you're looking at a settlement statement and you see something that's 0.25, amid all of these huge numbers, thousands, tens, maybe hundreds of thousands of dollars, most people don't pay any attention to that. But in English, YSP equals 0.25 should tell you that that is an extra quarter point that you are being charged on the mortgage. So a $200,000 mortgage, a quarter of a point is actually $500. As of April 1st, 2011, yield spread premium no longer exists. It was taken away from us by the federal government. And actually, if you look at the number of mortgage brokers who left the industry after that April 1st, 2011 date, you'll see that the industry was greatly reduced in size. Tons of mortgage brokers left because they could no longer charge that yield spread premium. But that is typically what used to be referred to as the back end of a loan. And just so you know where that comes from, when the underwriter was quoting a rate, an interest rate for that consumer, some mortgage brokers were actually marking it up. So as an example, if the lender's willing to do a deal for 4.5%, and the mortgage broker turns around and charges the customer 4.75%, that 0.25% was yield spread premium, and that was money that was going directly into that mortgage broker's pocket. Thankfully, that doesn't exist anymore. The next thing I want to make sure you're aware of, and I use the word once so far in this video, is to talk about the concept of amortization. Amortization means the gradual repayment of loan principal over time. So the way that works is, if we borrow X amount of money and we're charged some interest rate for that money, we would like to be able to keep that payment consistent so that we know we have our income coming in and we have our housing expense going out. We want to keep that the same. Well, if you make your very first payment on that mortgage, you probably know that the overwhelming majority of that payment is going to be interest, and just a little sliver of that is going to go to pay down the principal. Now comes month 2. It's time to make the exact same payment. But since we have paid down our principal just a little bit, we actually owe a little less interest because you pay interest on the principal that's outstanding. So now, when we pay our interest, we're paying a little bit less. If the payment is consistent, that means a little bit more of that payment can be used to pay down the principal. So typically the way it works in a regular amortized mortgage loan is that every time you make a payment, a greater percentage of that payment reduces principal, and a lesser percentage of that payment is going toward interest. And if you could fast forward toward the end of that loan, you'll see that the vast majority of your payment is actually going toward the principal, and very, very little of it goes toward interest. So that is the concept of amortization. And if you followed me there, then I have to share with you the amazing, incredible concept, I say that sarcastically, of negative amortization, or what was known in our industry as a neg-am loan. Thankfully, we're not doing these very much right now. But remember what I said. If you want to see the future, look at the past. A neg-am product is when the payment you are making is not even enough to cover the interest. So follow me here for a second. Think of what I just said. If we borrow X amount of money and we amortize that loan, we know that we have to make X amount of payment every month to cover the interest and hopefully work down the principal a little bit as well. Well, what if the lender gives you the option of making a payment that doesn't even cover the interest? So now what happens? Not only are you not paying down the principal, but you're short on the interest. The amount of the deficit of interest actually now becomes principal. So now let's go to month 2. You owe more in principal than you owed the day you took out the loan. And every month, the payment that you're making is not even covering interest. You are adding and adding and adding to the principal. This ridiculous concept, born on Wall Street, by the way, was based on the theory that real estate will always go up in value. So someone could always refinance or sell their property and get out from this kind of a neg-am product. As we all know, or should know by now, real estate does not always go up in value. And which homeowners do you think were hurt first when values started to drop? It's going to happen again, folks. Mark my word. And we want to avoid those neg-am products whenever possible. I know the payment can be attractive. It can enable a borrower to get into a home that they normally couldn't afford based on their income. It is a formula for disaster, or another word for disaster in the real estate industry is the word foreclosure. I want to talk about balloon payments. If a borrower is paying only interest on the loan instead of amortizing it, then at some point that principal balance is going to come due. And that is what we refer to as a balloon payment. So if we are not amortizing, we're not negatively amortizing, but we're simply making that interest-only payment every month, at some point, we're going to have to face the reality that we haven't touched our principal, and again, that is the balloon payment. So if you've got hundreds of thousands of dollars under the sofa cushion, great. You can then settle that balloon payment. But for the vast majority of the rest of us, it's going to be time to refinance if we can, or if not, it's going to be time to get out of that house, to sell it to someone else. So if you listen to the 3 financing concepts that I just discussed with you, amortization, which in my opinion is what we want, negative amortization, which is what we totally don't want, and interest only / balloon payment, let's go back in time and talk about the fact that some borrowers could make any one of those 3 payments. It used to be called pick a payment, and people would literally get a statement in the mail that said, how much do you want to pay? Do you want to pay this $1,400 amount? Do you want to pay this $1,700 amount, or do you want to pay the $2,100? And of course, I'm making up the numbers for purpose of illustration. But if you got a bill in the mail and said, what do you want to pay? The low amount, the medium amount, or the high amount? Chances are you're going to pay the low amount, right? Well, that low amount was that negative amortization product. How did people get in trouble? I don't know. I just can't figure it out myself. I want to talk about an industry term called option arms. And when we say ARM, it stands for adjustable rate mortgage, an option arm. So this was another brilliant Wall Street concept that lenders created to get people into homes that they couldn't afford, of course. And then these bad loans were bundled and sold as derivatives, but we're not going to go there in today's video. We're teaching real estate finance, right? So option arms, these adjustable rate mortgages, were often cases where buyers were pre-approved at teaser rates. Teaser rates. Have you ever gotten in the mail a credit card offer that says, for the first 6 months, you're only going to pay 1.9% interest, transfer your balances over here? People are sometimes attracted to those because of the very, very low interest rate. What do you think happens when that teaser period is up? You think interest rates are going to go up? When interest rates go up, you think the payment's going to go up? And what's going to happen to that poor person who took advantage of that teaser rate and now they're facing, a 15, 18, 22% interest rate on that credit card? They're really screwed, right? Well, when it comes to mortgages, there were teaser rates that were being offered to people. Sometimes they were the flexibility, like I said to you with the pick a payment a couple of minutes ago. Sometimes they were interest-only loans, and there were all other kinds of creative products that were being offered to people. My suggestion, even if you can get one and it's not easy, is to stay away from an option arm today. Now, some of my viewers might be listening to these concepts and saying, hey, these are great strategies. These strategies offer flexibility. They allow people to buy homes who normally couldn't buy those homes. These are good things. These are good things. Some of my viewers might be listening to me right now saying, hey, these exotic loan products that Brad is talking about, these are borderline predatory lending. So I'm not going to be the moral judge today and tell you where I stand on that, whether these are viable financial tools or whether this is predatory lending. I'm going to leave that up to you to make that decision. Next thing I want to talk about is known as hard money. So when we talk about hard money, it's really a mortgage of last resort. It's going to someone who is typically going to charge a much higher interest rate. Typically, it's going to be a shorter term mortgage, and typically they're going to require that the borrower put more money down. But if somebody is in a desperate situation, for whatever reason, they really, really want to get a mortgage and buy a property right now, and they can't get conventional financing, they can't get FHA or VA financing, and they feel compelled to go to a hard money lender, that is absolutely their choice. For us as real estate professionals, there's really no difference in how the process works or how the offer is constructed. There is a happy medium I want to tell you about, somewhere between conventional financing and hard money, and that is credit unions. So here in Southern Nevada, we are pretty fortunate that we have a lot of credit unions. I'm not going to mention any by name right now, but you've probably seen commercials and you've seen the advertising, or you've driven down the street and you've passed them. Credit unions can be a little bit more flexible, a little bit more creative in how they put a mortgage product together. So if you've got a buyer and they're struggling to get traditional or conventional financing, before they resort to hard money, you might suggest that they talk to a credit union. After the market crashed around 2008, condominiums became very difficult to finance. In fact, condo conversions were almost impossible. In case you don't know what a condo conversion is, it's a former apartment complex that got a new coat of paint, a couple of new appliances, and a name change, and they decided to sell it as condos. So condo conversion meaning converted from apartments. So condos became very, very difficult to finance after the crash. And it was largely due to two primary reasons. One was the high percentage of delinquent assessments. Most lenders would say that if more than 15% of unit owners were delinquent on their assessments, then they were not willing to go ahead and finance a unit in that community. And the second reason had to do with the large number of units that were being purchased by investors. In fact, most lenders said that if more than 35% of the units in a condo development were owned by investors, in other words, not owner-occupied, that you also could not get a mortgage in that community. So more than 15% delinquency rate or more than 35% non-owner occupied rate, and pretty much those two things would mean that you were not able to get a mortgage in that community. Now that has loosened a bit over the years, but FHA can still be quite tough in that regard. So some advice to my associates who are going to work with a condo buyer who's not paying cash, and that is to talk to a lender, talk to Michael Ivanoff, and see about a particular community before you go out and show it. And as of right now, this is 2020 that we are filming this video, there are still more condo communities around Southern Nevada that cannot be financed than can. So it would be a waste of time, very frustrating and aggravating for you and your buyer to go out and show condo communities to a buyer hoping to get a mortgage, and then later find out that that community doesn't qualify at all. And the list of condo communities is changing all the time. So I would kind of work in reverse. I would talk to the lender, see if the community is approved. If it is, then I would go show in that community, as opposed to showing, writing an offer, negotiating a deal, and then hoping to get a mortgage. The next thing I want to talk about today is HELOCs. HELOC stands for Home Equity Line of Credit. A home equity line of credit can be a valuable tool, especially if you're a real estate professional. You might want to keep a HELOC on your home. Because that way, if you come across a good piece of property that you want to buy, maybe you come across a good deal, you can actually access funds from your HELOC to write a down payment on that property. Now, a HELOC, even though it is a type of mortgage, should be thought of more like a credit card. And when I say that, what I mean is, if you get a traditional mortgage, you borrow X amount of dollars, and from the time you borrow it, you start paying interest on the amount. With a HELOC, you actually only start paying interest from the time you borrow money, and you only pay interest on the amount you borrowed. So let's say, as an example, you get a $50,000 HELOC on your home. It's like having a credit card that you're not using. It's available to you. Now, some point in the future, you decide, I'm going to use my HELOC to buy a car. And you take $20,000 from that $50,000 HELOC, and you write a check to buy a car. Now, you're only paying interest on the $20,000, not the $50,000. And you're only paying interest from the time you borrowed the $20,000, not all the way back to the time you initiated that HELOC. So that's what I mean, that it is more like a credit card. A lot of people were using HELOCs for purchase money. And that's a little bit of an explanation I need to get into here. So if we go back in time to when people used to get 80, 90, 95% financing as a first mortgage, it became very risky for the lender. And lenders instituted a rule that if you got more than 80% loan to value, we call that an LTV, if you got a higher than 80% LTV as a first mortgage, you had to pay mortgage insurance. So a lot of people would cap their first mortgage at that 80% LTV so they didn't incur the cost of mortgage insurance. So on a $100,000 purchase, an 80% LTV would give you an $80,000 mortgage. That would mean that you would have to come up with the additional $20,000 some other way. Well, there's always the possibility, although it's a small possibility, of seller financing. There's also the possibility that the buyer has that $20,000 liquid and is able to put that into the transaction. But there is one other way that people came up with, and that was to use the HELOC, and to use the HELOC as purchase money. So in a lot of cases, people were getting an 80% LTV first mortgage, again, to get away from paying mortgage insurance, and then they would get a 10, 15, even a 20% HELOC as a second mortgage. So if you take 80% first mortgage, 20% HELOC, you've got your 100% financing right there. Now, just in case you're thinking, hey, that might be a little tricky, how would the bank feel about someone getting a HELOC and using it as purchase money? Let me tell you that in a lot of cases, people were getting an 80% LTV on the first and a 20% HELOC from the same bank. That's kind of interesting, isn't it? So people would get that 100% financing, and they wouldn't have that mortgage insurance. And just to clean up a couple of points about mortgage insurance comes in two different variations. One is known as PMI, which stands for Private Mortgage Insurance. The other one is known as MIP, which stands for Mortgage Insurance Premium. A PMI mortgage insurance is for conventional financing, while MIP is for FHA financing. There is no mortgage insurance on VA loans, by the way, because they're guaranteed by the U.S. government. Now, earlier in this video, we were talking about terms and conditions of a mortgage, because there's a lot more to a mortgage than just an interest rate. So one of the things that we need to look at, in addition to that interest rate, is whether the loan product comes with any kind of prepayment penalty. Prepayment penalties are not as common as they used to be, but they are still around, and they come in two different variations: a soft prepayment penalty and a hard prepayment penalty. And I want you to know the difference. A soft prepayment penalty will only take effect if you refinance your mortgage. A hard prepayment penalty will take effect if you refinance the mortgage or if you sell the property. Now, what the heck is a prepayment penalty? Well, it is a way of the lender guaranteeing some profit. Lenders will tell you that when they initiate a new mortgage, they incur all kinds of expenses, and they need to recoup those by collecting interest, right? So when we pay a mortgage normally, we pay interest every month, or we call it interest. Actually, banks refer to that as profit. If you get a mortgage and you pay that mortgage off very, very quickly, let's say you're out playing a slot machine and you hit the megabucks or whatever it is, and you decide you want to pay off your mortgage. You pay off that principal balance, and now the bank is not earning any more any more interest on that mortgage, right? They don't like that. They like you to carry your mortgage to the full term. So as a way to kind of guarantee their profit, sometimes lenders will institute prepayment penalties as part of the loan product. And as I said, soft, which is in the case of a refi, or hard is a refi or sold if you sell that property. How much is a prepayment penalty? Well, it varies. But what's common in the industry is an amount of money that's equal to 6 months worth of interest. So that could be a fairly significant penalty. How long does a prepayment penalty last? Well, that varies by lender, but most of the prepayment penalties that I've seen last anywhere from a year to 3 years, meaning once you get to that 3-year mark in your mortgage, that prepayment penalty falls off, meaning that the bank has earned enough profit to recoup their expenses by that point. So prepayment penalties are definitely something that we want to consider, especially if you are working a job that may be calling for you to move to a different city, and you have to turn around and sell your house. You could be incurring a very, very significant penalty. This is completely negotiable, by the way. And if you think there's a likelihood of having to sell your house within a short period of time, then you might want to even do what's called buy down that prepayment penalty by paying a slightly higher interest rate in lieu of incurring that prepayment penalty. All of this is completely negotiable. I used to say that a lot of lenders will not refinance a property if it's currently on the market for sale. And what I have to tell you now is a lot of lenders will not refinance a property even if it has recently been on the market for sale and no longer on the market today. A lot of lenders, especially when the market gets a bit softer, a lot of lenders are jumpy when it comes to stability, when it comes to the longevity of that mortgage. In other words, what is that homeowner going to do? So if you put that property on the market for sale and you don't sell the property, chances are you really want to get out of there, and when market conditions change, you might put that back on the market for sale again. So a lot of lenders will not refi, which means giving you more money, right? Even if you've had that property on the market for sale recently. This is an interesting point to keep in mind when you're out on a listing appointment and you're talking to a seller, and the seller is not sure what he wants to do. Does he want to sell the house? Does he want to stay, refinance his mortgage? Does he want to build that extra bedroom on the back of the house? Maybe he thinks he can easily refi the house to get that money, to get the cash to do that building. Maybe he can't anymore. Now, we've talked about how important it is to disclose the interest rate, disclose the prepayment penalties. What I need to tell you now is that as of October 3rd of 2015, so October 3rd, 2015, because of the Consumer Financial Protection Bureau that we talked about earlier in my Class 2 videos, the GFE, the good faith estimate, has been taken away. The TIL, the truth in lending, has also been taken away. And those two documents, the GFE and the TIL, have been replaced with one document that is now known as an LE. An LE stands for a loan estimate. But one thing that didn't change in 2015 when the CFPB got involved was the fact that this estimate still needs to be provided to the borrower, or we call it the buyer, within 3 business days of submitting that mortgage application. So that is tied to the consumer protections that we talked about earlier, that just in case that consumer gets that loan estimate and doesn't like the interest rate, doesn't like the prepayment penalty or any other terms and conditions, they still have time in the transaction to be able to go out and shop around with another lender. The next thing I want to talk about is a situation where a seller may give some credit to a buyer as part of the negotiations. It is done all the time where a buyer writes an offer on a property and asks the seller to contribute to the closing costs or what have you. And this concept is absolutely okay as long as it's completely disclosed. Now, if you're a buyer getting a mortgage, you definitely want to check with your lender on this. And years ago, a lot of lenders used the 6% rule of thumb, meaning that the seller could contribute to the buyer's closing costs as long as they didn't exceed 6% of the purchase price of the property. However, today, most lenders follow the 3% rule of thumb. So if you're a real estate agent now representing a buyer, and you're going to go out there and write an offer that asks for the seller to pay some of the buyer's closing costs, my suggestion is to never ask for anything more than 3%. It could be rejected by the lender later. So we want to keep that seller concession to 3% or less. And of course, anytime a buyer is getting any kind of concession or credit from the seller, it must be on that settlement statement. There can't be any checks, any envelopes outside later surreptitiously given from the seller to buyer. Everything has to be completely disclosed and on the settlement statement. I'd like to circle back to something that we talked about a while ago in this video, which was the difference between a deed of trust and a mortgage. And the reason I'm circling back is because I've used the word mortgage so many times in this video. So remember, here in Nevada, we don't technically have a mortgage, even though that's our common parlance. We really do have a deed of trust. And I also told you earlier that the primary difference between a deed of trust and a mortgage is that a deed of trust is in a non-judicial state like Nevada, but a mortgage is in a judicial foreclosure state like New York is one that comes to mind. And I'm circling back to reiterate that point and to say that lenders prefer deeds of trust. Consumers prefer mortgages. And the primary reason that lenders prefer deeds of trust is because they're quicker, cheaper, and easier to foreclose if they needed to do so. And the very last thing I want to talk about in this video is that in the state of Nevada, we are a non-redemption state. Not only are we a non-judicial foreclosure state, we're also known as a non-redemption state. What the heck is redemption? Well, in some states, like Alabama comes to mind, there is the legal right of redemption. meaning that if someone loses their property to foreclosure, the buyer does not actually get title to that property for a certain period of time, typically 30 days. So actually, in a redemption state, the title goes into escrow. I know that's a very awkward and funny sentence for us here in the state of Nevada, but there's a period of time during which the seller has lost the rights to the property at the foreclosure auction, but the buyer has not yet acquired the rights to the property. There's kind of that purgatory period in the middle, if you will. We don't have that in Nevada, except in the case of a common interest community foreclosure. If it is the common interest community, the homeowners association or the condo association that forecloses on the property in the state of Nevada, there is a 60-day right of redemption. However, those foreclosures are rare because they're so fraught with liability and problems under our current law. The vast majority of time in the state of Nevada, someone loses their property to foreclosure. It is a lender who is doing the foreclosure. It is not the common interest community. And in the case of a lender foreclosure in the state of Nevada, there is no redemption period. I would like to thank you for watching this video. I hope it was informative for you. If you are licensed with another brokerage in Southern Nevada and would like to talk with me, please text me or visit our website. See you next time.